The Dow heading up for its 8th day in a row, the longest winning streak since September of 2019. Our next guest says the market rally just beginning. If the Fed pulls off a soft landing, that is. Joining me now, Alicia Levine, BNY Mellon Wealth's head of investment strategy and equity advisory solutions. It's a big title.
Big title.
What are your big thoughts on the market? As you know, some on the street are now taking up their targets.
Right. So we've taken up our targets also primarily because the recession is nowhere in sight. And while we do have a 40% chance of recession over the next 12 months, that's getting almost close enough to the average year of 20% if you add 2 years in a row. So the data so far are telling us in the next 3 to 6 months the recession's not happening. And if that's the case, earnings will go higher than expected, and then the multiples will move higher and the targets go higher as well. So far, credit to the Fed, because they pushed on this, and there was a lot of skepticism that they could actually pull it off. I'm not 100% certain, but I'm more certain than I was.
No, because people say it's too soon to sound the all clear.
I think it probably is too soon to some extent. But if you look at what if there's no recession, you're then forced to say it's different this time. So if you say it's different this time, you have to say, well, what's different? I think the antecedents are different, meaning there were no imbalances in the economy. You didn't have credit stress going into this. You have a mortgage market that is essentially a 30-year fixed at under 3%. So the normal transition of a higher Fed interest rate is not damaging the housing market to the same extent. There are pockets. So I would call out regional banks as an area of potential concern. Clearly, the real estate issue, $1.5 trillion coming due by the end of 2025. Those are areas of concern. And then not least is yield. So if yields stay below 4%, we're in a happier place. And you saw last week when yields got above 4%, the market didn't like it.
Yeah, well, we came down pretty quickly off that. I mean, your overall point is that things were different at the beginning, so they may, in fact, be different at the end.
They could be. And I think we have to open our minds to that this is not automatic. So the normal way that you get credit contraction and the normal way you filter tighter Fed policy, just very different. And let's talk about fiscal policy. Fiscal policy also apparently works with long and variable lags. And the Biden administration has passed $2 trillion worth of spending that is now going to be poured into the economy, mostly in the industrial sector. So if that's where earnings are coming from, you've stabilized earnings as well. It's just a different cycle than it was in 2006 and 2007, which I think most people were concerned about.
New highs this year? What do you think? It's the poll we asked our viewers today.
I'll say this. I think it's entirely reasonable with no recession to end the year with a 24-month retracement to the old high of 4,800. That seems reasonable based on history if there's no recession.
What about where valuations are right now? What some would say are just too rich to the historical average of the S&P relative to where we are and where earnings are now, and that expectations for 24 are just still too inflated.
Okay, so let's take out those top 7, which are trading at 40 times forward 12 months.
I knew you were going to go here, right?
Knew it. Then you're
well, that's because that's the comeback that people have for you. You take those out.
Look what's working. Financials, healthcare. And even energy's gotten a bid. So the areas that were left for dead are actually starting to work. Small cap are starting to work as well, which is telling you that if we have some sort of a cyclical recovery, then the earnings have to go higher. It means your multiple's not going to be as high as well.
Transports have been working. I mean, other areas beyond tech are starting to look pretty decent.
Right. It feels concerned. Like, look, we're paid to worry. Right? That's what we do. We worry. You have to worry about the left tail risk. I just think that the downside is not as dire as when we came into the year. And so, therefore, you have to start looking to what can go right. And this is what can go right.
Well, a raging, or at least an advancing bull market makes people more bullish. That's just human nature, I suppose. Alicia, thank you.
Thank you.
Alicia Levine joining us right